Car finance scandal. Millions could claim compensation. Supreme Court ruling. The UK's Supreme Court could decide whether hidden car finance commissions are illegal, sparking a major debate over millions of drivers potentially claiming compensation for mis-selling. This landmark ruling, set to be decided soon, could reshape the automotive finance landscape, with thousands of motorists already waiting for clarity. But here's where it gets controversial. The industry argues they did nothing wrong, while critics say dealers secretly pocketed commissions, exploiting vulnerable buyers. And this is the part most people miss: how the law might now hold up the dealers' loopholes, forcing them to pay back what they stole. The ruling hinges on whether nearly all hidden commission arrangements, including the controversial discretionary commission agreements, DCAs, banned in 2021, were unlawful. If the Supreme Court upholds these bans, it could trigger a wave of lawsuits, with many drivers now in line for payouts. Lenders like Lloyd's have already set aside billions in reserves, anticipating payouts similar to those seen during the PPI scandal. Yet the industry insists they followed the law, citing regulatory guidelines, while critics argue the rules were never clear enough. How cars were bought. Most new cars, and many second-hand ones, are financed through loans. Buyers deposit a portion, take out a loan, and drive off. Dealers signed up customers for these deals, secretly pocketing commissions from lenders. Some dealers earned more if they secured higher interest rates, a practice called DCAs, which regulators banned in 2021. Car loan scandal, payouts row, what's it about? https www.bbc.co.uk/news/articles, C2B L9VVJ097LO. The Financial Conduct Authority, FCA, is likely to create a central compensation scheme for drivers who were missold loans, with DCAs. However, some like Jemma Caffrey, a mother of two, want to take their cases to court to demand larger payouts. In 2009, she bought a car after maternity leave, struggling to afford public transport. She paid a high interest rate for a blue Corsa, only realizing years later that her lender had secretly paid her a commission. Now, she's fighting for justice, highlighting how financial systems can exploit vulnerable consumers. The Supreme Court is considering 3 test cases, including one involving Marcus Johnson, a 34-year-old from Torfaen. He bought a Suzuki Swift in 2017, unaware of a hidden commission. His solicitors argue the commissions amounted to bribes under common law. The Court of Appeal previously ruled that dealers must prioritize buyers' interests over lenders, a shift that could redefine the role of dealers in the finance sector. Economic fallout. The car finance sector, the second-largest consumer lender in the UK, faces scrutiny over compliance. The Finance and Leasing Association warns the ruling could force lenders to pay billions, raising costs for future loans, potentially affecting credit cards, personal loans, and mortgages. Stuart Masson, editor of the Car Expert UK, warns that lenders might claw back money by increasing lending costs, saying they're going to have to get that back from increasing the costs of future lending. But Bobby Dean, a Liberal Democrat MP, argues fairness shouldn't hinder growth. He says good regulation protects consumers and ensures confidence in car loans, benefiting the economy. The Treasury is concerned this case may deter investment, slowing economic growth. As the Supreme Court deliberates, the debate continues. Will this ruling protect the industry or expose its flaws? Will drivers see justice or will the system remain opaque? Let's follow the verdict as it unfolds. Rachel Reeves to overrule Supreme Court on £44 billion car finance scandal. In a surprising turn of events, Chancellor Rachel Reeves is contemplating the possibility of overruling the Supreme Court regarding a staggering £44 billion car finance commission scandal. This decision comes in light of intense lobbying from some of the largest lenders in the UK, as reported by The Guardian. The government is currently exploring contingency plans in case the Supreme Court justices decide to uphold a shocking ruling from last October. This ruling indicated that customers might be entitled to billions in compensation due to unlawful commission payments made to brokers who arranged motor loans without adequately disclosing the amounts and terms to borrowers. If the justices confirm this ruling, the Treasury is prepared to retroactively amend the law to limit the financial liabilities of these lenders. Discussions have been taking place among officials from the Treasury, the Ministry of Justice, and the Department for Business and Trade regarding the feasibility of overriding the Supreme Court's decision, which is expected to be announced on August 1st. Such a move would mark a significant intervention by the Treasury, especially following Reeves' controversial attempt to influence the Supreme Court case earlier this year. The financial sector is on edge, eagerly awaiting the justice's decision on whether to fully uphold the appeal court's ruling. This ruling deemed the practice of paying commissions to brokers without proper disclosure to borrowers as unlawful. The regulations governing these payments are established through common law, which means they are determined by judicial decisions rather than by parliamentary legislation. If new primary legislation is enacted, it would grant Parliament the authority to dictate how commission arrangements should be handled and disclosed to borrowers. A critical aspect of the Treasury's considerations is whether these new laws could be applied retroactively. This would mean that they could affect previous cases and contracts, significantly reducing the potential £44 billion compensation liability from major lenders like Lloyds, Santander, Barclays, and Close Brothers. Implementing retrospective legislation could also prevent the scandal from expanding beyond car loans, potentially shielding lenders from complaints regarding commission payments related to other financial products, such as those for appliances and furniture. The government's contemplation of this move follows months of lobbying from the Financing Leasing Association (FLA), which represents car lenders, and Lloyds Banking Group, a key player in the scandal through its Black Horse division. Lloyds has already set aside £1.2 billion for potential compensation related to this issue. While it is uncommon and often contentious, the UK Parliament has previously enacted retrospective legislation concerning payouts. For instance, in 2013, the coalition government passed the Job Seekers Back to Work Schemes Act to protect the economy from a £130 million payout to individuals whose benefits were halted after they declined unpaid work for private companies. In that scenario, the legislation was aimed at safeguarding public funds rather than the profits of private entities. The discussions surrounding a potential intervention in the car finance scandal are particularly sensitive, as the government is keen to avoid appearing disrespectful to the judicial process. However, there is a growing concern that an unfavorable ruling could lead to a massive compensation bill, which might have dire consequences for the sector. The FLA has cautions that such a ruling could disrupt the car finance market, leading to fewer or more expensive loan options for consumers, and could even result in some lenders going out of business. The Treasury is worried that the ongoing scandal is discouraging investment and diminishing U.S. interest in UK company shares, especially at a time when the city is striving to rejuvenate the London Stock Exchange. Close Brothers, which allocates about 20% of its portfolio to car loans, has already set aside £165 million for the scandal, cancelled dividends, and announced plans to divest its asset management business to bolster its financial standing. Similarly, Santander UK reserved £295 million in November to address potential payouts, which has caused frustration among its leadership. If the government decides to override the Supreme Court's judgment, it would align with the Labour government's broader initiative to modify regulations aimed at stimulating economic growth. This initiative has already led to a series of changes in the city and the resignation of the chair of the competition watchdog earlier this year. In January, Reeves attempted to intervene in the Supreme Court case, cautioning the justices against granting consumers a financial windfall. The Treasury argued that it should be allowed to present its views to the court, as the outcome could result in considerable economic harm. However, this intervention was ultimately rejected. Lenders have contended that the appeal court's ruling from last October established a much stricter standard for disclosing commission arrangements and obtaining customer consent than they previously believed was necessary under the regulations set by the Financial Conduct Authority, FCA. There are also concerns that this judgment could pave the way for complaints across a broader spectrum of loans, where brokers receive commission payments. The matter was subsequently escalated to the Supreme Court, culminating in a 3-day hearing in early April. The judges are set to announce their ruling on August 1st. In response to inquiries about the potential contingency plans, a Treasury spokesperson stated, "We don't comment on speculation. We want to see a balanced judgment that delivers compensation proportionate to losses that consumers have suffered and allows the motor finance sector to continue supporting millions of motorists to own vehicles. It is now appropriate to let the appeals process run its course." Both the FLA and Lloyd's declined to provide comments on the situation. Is Britain face another multi-billion-pound consumer finance scandal? Britain could be on the brink of another massive consumer finance controversy, potentially costing lenders billions of pounds, and the upcoming Supreme Court decision on August 1st will be pivotal. But here's where it gets controversial. This ruling revolves around commissions paid in car financing deals, money that may have been kept under wraps from customers. And this is the part most people miss. The implications could ripple far beyond car loans, shaking trust in the entire consumer finance market. On Friday, after the London markets close, Britain's Supreme Court will deliver a groundbreaking judgment that could pave the way for consumers to claim billions in compensation from banks and finance companies. This follows a prior Court of Appeal decision that declared it unlawful for lenders to pay commissions to motor dealers without customers being fully informed and consenting. Major UK lenders including Lloyds Banking Group, Close Brothers, Barclays, and the UK divisions of Santander and Bank of Ireland have already provisioned nearly £2 billion, roughly $2.7 billion, to cover possible compensation, signaling the magnitude of potential payouts. To put that into perspective, this could rival the financial fallout from the mis-selling of payment protection insurance, PPI, which ultimately cost banks around £40 billion and concluded with a regulatory deadline in 2019. So what exactly is the Supreme Court reviewing? The judges will re-examine 3 prior claims, 2 involving South African lender First Rand and 1 against Close Brothers, to clarify the duty of car dealers when acting as credit brokers. Essentially, the court must decide how much information dealers should have given customers regarding commissions paid by lenders. Another key point is whether these payments were hidden, and if lenders acted unfairly by not disclosing this financial arrangement. How does this affect you or millions of other UK car buyers? Although the Financial Conduct Authority, FCA, banned discretionary commissions in 2021, allegations remain that customers were unfairly treated before the ban, triggering an FCA investigation earlier this year. If the court rules that lenders and dealers were not transparent enough, the FCA plans to consult on setting up a compensation scheme within about 6 weeks following the decision. The motor finance market is huge. Over 2 million people annually rely on it to purchase vehicles, according to FCA data. However, only some lenders have motor finance portfolios large enough to face significant losses. Lloyds, Close Brothers, and Santander UK have made provisions of £1.15 billion, £295 million, and £165 million respectively, while Barclays and Bank of Ireland have reserved smaller amounts. Here's the potentially explosive angle. The ruling might open the door for scrutiny of other commission types paid to credit brokers beyond the motor finance sector. If full informed customer consent is mandated, the cost to the industry could balloon dramatically. Moody's estimated a worst-case scenario industry-wide cost of up to £30 billion last November, while bank analysts at RBC Capital recently revised this figure to around £11 billion. With stakes this high, there are whispers that the UK government might intervene. Finance Minister Rachel Reeves reportedly has considered legislative changes to protect lenders from the most damaging financial consequences, even possibly overriding the Supreme Court's decision. Although the Treasury officially refrains from commenting on speculation and insists on awaiting the full appeals process, the government has openly expressed its reservations about the initial Court of Appeal ruling. In early 2025, officials emphasized the need for a balanced approach that supports consumer claims while ensuring lenders remain able to provide car financing. So, is this a fair outcome? Should lenders be held accountable for non-transparent commissions? Or is the government right to worry about the wider economic fallout? Could we be witnessing the start of another sweeping financial scandal reminiscent of the PPI saga? The Supreme Court's ruling will offer answers, but it's clear this decision will spark fierce debate across the financial world and among everyday consumers. What do you think? Should transparency in finance be absolutely non-negotiable, or are there risks in pushing lenders too far? Feel free to share your thoughts and engage in the conversation below.